Crypto whales are one of the most fascinating and powerful forces within the cryptocurrency market. And understanding how they operate is essential for anyone who wants to trade Bitcoin, Ethereum, stablecoins, altcoins, memecoins, and the larger blockchain ecosystem with confidence. In every financial market, there are large players who hold enormous amounts of capital, but in the crypto world, these major holders have even more influence because the market is still relatively young, decentralized, and highly dependent on liquidity and market sentiment. A crypto whale is simply an individual, exchange, institution, fund, or entity that holds a significant amount of a particular cryptocurrency. Because the supply of assets like Bitcoin is limited, whales who hold thousands or tens of thousands of coins can dramatically impact price movements without saying a word. This is why understanding whale behavior has become a key part of crypto technical analysis and crypto market prediction. Traders rely heavily on whale tracking tools, on-chain analysis platforms, and blockchain explorers to know when whales are buying, selling, transferring, accumulating, or moving funds to exchanges, as these actions often signal major market shifts. Whales move the crypto market through liquidity impact, order book pressure, and psychological triggers. When a whale executes a large buy order, the price can spike suddenly, especially in small-cap altcoins with low liquidity. This causes fear of missing out among retail traders and leads to even more buying. The opposite happens when whales sell or move coins to exchanges. Even if they don't sell immediately, the simple act of transferring Bitcoin or Ethereum from a cold wallet to an exchange wallet creates panic in the market because traders assume the whale wants to dump their holdings. This reaction is known as whale-induced volatility and has been observed repeatedly in Bitcoin trading history. Whales understand this dynamic extremely well, and sometimes they create fake pressure in the order book to manipulate retail traders into buying or selling based on fear and greed. This is why learning how whale manipulation works is essential for proper risk management, especially in futures trading and margin trading, where liquidation levels can be wiped out instantly by a sudden price wick caused by a whale. Many retail traders believe that whales always have the intention to manipulate the market, but the truth is more complex. Sometimes whales simply reposition their assets for security reasons, such as moving funds into cold storage, diversifying exchanges, or transferring Bitcoin to OTC trading desks. OTC desks allow whales to buy or sell large quantities without affecting the market price, but the transaction still shows up on the blockchain. Because the blockchain is transparent, anyone with whale tracking tools like Whale Alert, Glassnode, Nonsen, or CryptoQuint can see these large transactions. This transparency creates a unique environment in which traders can follow the actions of big players, something that's not possible in the stock market. This is why on-chain data analysis has become one of the most powerful skills in crypto investing. Traders who monitor wallet activity can detect accumulation phases, distribution phases, and whale-driven market cycles long before retail traders notice any price changes. One of the key concepts every crypto trader must understand is whale accumulation. When whales accumulate Bitcoin or altcoins quietly, they usually do it during periods of low volatility when retail interest is weak. This is often called the consolidation phase. During accumulation, whales often set multiple limit orders across different price levels to avoid drawing attention. Once accumulation is complete, the market tends to experience a strong upward movement because whales now control a larger portion of supply. On the other hand, whale distribution happens when prices are extremely high, hype is strong, and retail traders are aggressively buying. Whales use this moment to slowly unload their holdings without crashing the market. This cycle of accumulation and distribution plays a major role in bull markets and bear markets, and recognizing these phases helps traders avoid buying tops and avoid panic selling bottoms. Whales also influence liquidations in the futures market. Because crypto futures trading involves high leverage, sometimes even up to 100x, a whale-driven price move of just a few percentage points can liquidate thousands of over-leveraged positions. When this happens, a liquidation cascade begins, pushing the market rapidly in one direction. Whales can intentionally target liquidity zones where long and short positions have set their stop-loss or liquidation levels. By pushing price into these zones, they trigger massive forced orders that amplify the move. Traders who understand liquidity hunting and whale manipulation are able to avoid common trading mistakes, such as placing stop-loss levels in obvious areas or using excessive leverage. This type of whale-induced volatility is one of the biggest reasons retail traders lose money, especially during periods of sideways consolidation when price suddenly wicks up or down before returning to the original level. It's also important to understand that whales are not always individuals. Many times, the biggest whales are exchanges, hedge funds, venture capital firms, institutional investors, blockchain foundations, early miners, or even governments. These entities hold massive amounts of crypto for different reasons. For example, exchanges hold coins on behalf of millions of users, but the wallets appear as whale wallets on blockchain explorers. Foundations behind major blockchain projects also hold large treasury funds to finance development. Institutional investors may hold assets long-term as part of their portfolio diversification strategy. However, regardless of who the whale is, their movements still affect market sentiment because the market reacts strongly to large transfers and major wallet activity. This is why understanding on-chain data is a major competitive advantage for modern crypto traders. Whales also play a role in pump-and-dump schemes, especially in low-cap or micro-cap altcoins where liquidity is extremely low. A whale can easily buy a large percentage of a token supply, pump the price using coordinated buying, create social media hype indirectly through influencers, and then dump their holdings while retail traders are still buying. This leaves small traders with huge losses while whales walk away with profit. Because the crypto market is decentralized, such activities are difficult to regulate, making it essential for traders to avoid low-cap coins with whale-dominated supply. Tokens where a single wallet holds more than 20% of supply are considered extremely risky because one sell-off from that wallet can crash the entire project. Blockchain transparency allows traders to check token distribution before investing, and this simple habit can save many traders from falling into whale traps. Whales also shape market cycles through long-term investment behavior. During bear markets, when prices are low, whales often accumulate quietly. During bull markets, when prices are high, whales distribute. This behavior contributes to the cyclical nature of the crypto market. Traders who understand macro whale trends can position themselves better for long-term investing. On-chain indicators like exchange inflows, exchange outflows, realized price metrics, long-term holder activity, and whale wallet age play a major role in predicting major market reversals. When whales begin sending assets to exchanges, it often signals selling pressure. When they withdraw assets from exchanges to cold storage, it suggests accumulation and bullish sentiment. These patterns repeat themselves across every major bull and bear cycle since Bitcoin was created. Another way whales influence the market is through psychological manipulation. Large players understand retail emotions, especially fear and greed. Whales know that a sudden dump will create panic selling among inexperienced traders. They also know that a sudden pump will attract retail buyers who chase green candles without analysis. By taking advantage of these psychological weaknesses, whales accumulate during fear and distribute during greed. Retail traders who fail to understand these patterns often become victims of whale traps. This is why emotional discipline is considered one of the most important skills in crypto trading psychology. Traders must learn to avoid FOMO, avoid panic selling, avoid revenge trading, and avoid blindly following social media hype. Whale behavior becomes even more influential during low liquidity periods. Weekends, holidays, and early mornings in most major markets often have lower trading volume. Whales can easily cause large price swings during these periods because fewer traders are active. This is why unexpected wicks often occur during off hours. Understanding liquidity timing helps traders avoid unnecessary losses. During high liquidity periods, whales distribute or accumulate more subtly because sudden movements would be noticed immediately. Monitoring liquidity levels helps traders better understand when to expect whale-driven volatility. One of the most interesting parts of whale activity is how visible it is due to blockchain transparency. In traditional finance, large institutions operate behind closed doors. In crypto, everything is traceable. This is why on-chain analytics has become a powerful trading tool. Platforms that track whale movements have become essential for crypto research, crypto trading education, and portfolio management strategies. The combination of decentralized finance, blockchain transparency, and whale analytics has changed the entire trading landscape. Retail traders can now access data that used to be limited to institutions. Crypto whales also influence narrative cycles. For example, during certain periods, whales may accumulate AI tokens, gaming tokens, DeFi tokens, or Layer 2 tokens. This can spark sector-wide rallies because retail traders follow the money flow. Whales often position themselves early before narratives become mainstream. By the time the public becomes aware, whales are already in profit. Understanding narrative rotation helps traders identify early opportunities without blindly following hype. Because whales hold so much power, many traders try to follow their strategies by monitoring wallet activity. While this can be helpful, following whales blindly is risky because their goals are not the same as retail traders. Whales can hold through long periods of volatility, but retail traders often cannot. This is why it's important to combine whale data with technical analysis, market structure understanding, and personal risk management. If you want to master crypto trading, understand market cycles, and learn how professionals analyze the cryptocurrency market with confidence, make sure you follow, stay connected, and never miss any powerful insights that can help you grow your portfolio and trade smarter every single day.